Welcome back to Market Shares. I'm your host, Tony Blodgett, and today I just want to do a quick market update, a little check-in, if you will. Here we are in the month of June. I don't even know how the year goes by so fast. We're almost at halftime in 2023, and I thought it'd be a good time to go back and look at some of the things that we talked about as we just were rounding the new year, see how those things are holding true, and maybe talk about what I expect to have happen here as we round out the second half of 2023. So buckle up. Here we go. We're gonna do a little gut check on where we're at. So one of the things that I said at the beginning of the year is rates are going to continue to be elevated. Well, sure enough, rates got a little better in January. If you guys remember, February was great and we've kind of oscillated. We're actually up towards close to the highest interest rates that we've seen here as we're in June. Now, all expectations were that, come May 10th, you guys heard, I'm not going to belabor that point, but that would be the turning point in interest rates. And I still believe that this is going to be, this summer is going to be the turning point for interest rates. But nonetheless, halfway through the year, rates are still very elevated, and they're in the high sixes, low sevens even. This can really vary widely. We've talked a bit on this program about loan level price adjustments. So, I mean, gosh, if you're buying a second home, an investment property, if you have a lower FICO score and you're doing a conventional loan, or an FHA loan for that matter, all these things can really put your interest rates well into the 7% range. And for those of you with great credit, or the seller's helping to pay closing costs, maybe you got rates in the sixes. But look, I mean, they're as high as they've been. So that hasn't changed, but I think that it's going to. So we'll talk a little bit more about that as we talk about the end of the year. Margin compression is still here, if not worse than ever. There's less total volume in the marketplace. And so as a result, everyone's clamoring for market share. And as a result, margins are very, very thin in the mortgage industry. And here we are at the middle of the year. Nothing has changed. If anything, it's gotten worse. Sales matters more than ever. And you guys, I'm going to stick by this one. The people that we see doing well in this market right now are because they have recognized that as mortgage professionals, we are salespeople, and there is a process. And if you can really hone your skills around that process, then you're going to have more success. So sales is more important. And I can tell you that what I'm witnessing as far as performance is those people that are engaged in honing their craft and their skills as a salespeople are the ones that are having success. So that is playing out as expected here in 2023. It's a numbers game. It's still a numbers game. The numbers are not great. So it's just more repetitions, more cycles. Relationships are the key. I said this in January. I would say that is absolutely holding true. Now, home values. So I just spoke about this, and home values had their peak in about June of 2022. Now, my prediction was they'd be pretty flat here for 2023. That's what I said at the beginning of the year. But here's what we're actually seeing is that in June of 22, they hit their peak. I would say in April, May, they reached their trough, and we're actually starting to see home values increase again here in the month of June. So look, that window of time where home values dipped, and it ranges, I would say overall, maybe we're talking about a 10% dip from where they were. Keep in mind, year over year numbers are still really good in almost every, year over year timeline that you might look at. But home values starting to increase is what it looks like at this point. Inventory still at an all-time low, so not much has changed there. I made some comments about keeping deals together. Seller concessions, we there was like this little tiny window of time where we were talking about seller concessions to fund buy downs to help buy the interest rate down, so on and so forth, right? Because we had this little period of transition when values started to dip a little bit. Look, I can tell you, in most cases, seller concessions came and went like a fleeting thought. You are not getting a lot of negotiation right now simply because of the low inventory. And, look, we're full into the spring market. It's slower than a normal spring market, but nonetheless, we're in the spring home buying market, and there's not a lot of seller concessions. So that has changed since the beginning of 2023. And then it's just about product, program, being creative. This is continuing to be on the forefront of everyone's mindset, finding loan products and programs that help people on the fringe get into homes. Maybe this is programs like non-QM, bank statement loans, asset depletion, things of that nature. But the other area that we're seeing a lot of resurgence is with construction loans, and people that aren't able to find that perfect home that they want are doing, building their own home or even doing renovations on a loan. So purchasing a home that is maybe a bit of a fixer-upper so that they can find a home, and then from there doing a renovation type of a project with the hope that at some point in the near future, not only do they have some built-in equity from doing the improvements of the home, but they can also restructure their interest rate and do a refinance. And then the one other big thing, which I didn't even mention at the onset of 2023, but I think is a pretty big opportunity right now, is cash out and debt consolidation loans. I know it's difficult, right? Because mortgage interest rates are higher right now. And especially for conventional loans where you're trying to do a cash out, the loan level price adjustments that we've talked about on this show obviously make it more difficult. But I think that what we have to be careful of as mortgage professionals is not talking ourselves or our clients out of even considering a cash out refinance because of the interest rate they currently have. I've heard a number of loan officers say this, like, I wouldn't even consider doing a cash out refinance. I mean, your rate is in the 3%, blah, 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 low fours, whatever that number is. We have it in our mind that why would you ever want to trade an interest rate at 3 3/4 for a rate at 6 3/4? You go, that's absurd. Well, is it? Because there's more things to consider for a number of the households and families that we serve in mortgage banking. And yeah, sometimes we can consolidate someone's, consumer debt. Maybe they have car payments, credit cards, other consumer loans that for whatever reason, they've racked up over time. And it makes sense just simply by looking at the interest rate, the blended rate of their consumer debt and their mortgage debt, their what we call overall household debt. Maybe it makes sense. But the other thing that I think people tend to not think about as much is maybe it's not about the blended rate. Maybe the blended rate even goes up a little bit. However, what if it substantially changes their monthly budget cash flow situation? And for some families right now, I promise you, they're having a tough time filling up the gas tank or buying groceries. And so cash flow becomes a more important factor than what your blended rate is on your debt. And if you have a lot of equity in your home that you've built up over the last couple of years, and for whatever reason, you surmounted a large amount of consumer debt that in many cases is a variable interest rate tied to the prime rate, which goes up every time the Fed has increased interest rates, you might have large monthly payments that you don't even feel like you're getting ahead on, and a debt consolidation, a cash out, a restructuring might benefit you even if the interest rate is a bit higher. So I challenge all of my mortgage friends and real estate friends, if you're talking to people about this subject, let's look at the whole situation. Let's look at blended household debt, interest rate. Let's look at cash flow and all those factors before we tell them it's a crazy idea to consider a cash out refinance. Now, look, of course, it's not for everybody. And if they're not in a situation where they really need to leverage that home equity for something, then of course, keep the low interest rate you have. I'm not here to suggest doing a mortgage just for the sake of doing a new mortgage. But we also can't overlook the challenges a family might be dealing with simply because in our mind, we haven't taken the time to put pencil to paper and do the math. And we just think trading out a high interest rate for a low interest rate is just absurd. Don't sell yourself or your clients that short. So that's my little take on cash out refinances. Now let's talk about what's going to happen as the year rolls on. So at the time I'm recording this, we just last week ratified or rectified or solidified the new debt ceiling arrangement. Sounds like a lot of compromise was made on both sides. The left wasn't super happy with it. The right wasn't super happy with it. I'm just happy that, they figured it out in time and we didn't see, any significant impact to our economy, because that would have been very devastating had they not figured that out. So look, I don't get too much in the politics of it. I'm just glad that it's behind us. No surprise, really. They do solve this problem every time it comes up. I think the last 27 times in a row, we've successfully raised the debt ceiling. This sounded like about a 2-year patch. I didn't watch it that closely, to be honest with you, because it always gets fixed. And it's almost like not that big of a deal, although had they not come to an agreement, would have been a big deal. But I will say this, it has caused some challenges most recently in the stability of interest rates. There's no question that the uncertainty around this debt ceiling issue definitely caused some trepidation in the market. So I'm glad to see that behind us so things can settle down and start following the normal kind of course of action, the normal course of business as we look at inflation throughout summer should be coming down. These employment numbers, I don't even know what to say. I mean, resilient employment numbers, although we did see the unemployment number tick up, which is a very strong recessionary indicator. And we just saw that last Friday. So, mixed messages on employment, but does seem like we're adding new jobs, but yet unemployment numbers going up, I'm assuming because of overall participation in the labor markets, et cetera. But that fact alone is a big one. When you see employment numbers go from the lowest of levels and start turning up, big recession indicator. The stock market seems to be pretty resilient. Again, I don't follow that super close, but broad strokes here, stock market, pretty resilient, especially our big tech stocks, right? The Googles, the Amazons, the Tesla, the large, the Microsoft, the large, players continue to be strong in this market, and the rest of the market's pretty mediocre, but nonetheless, it still seems to be quite resilient. So where does this put us for interest rates? Well, I think it puts us on the path that we've talked about throughout the year. Interest rates are going to steadily decline as summer goes on. There's no question about it. It hasn't happened quite as quick as what was anticipated, but I do think that we continue to see rates improve. And it's still my estimation that we find our interest rates with a 5 handle as we move into the end of the third, fourth quarter, probably mid 5s by the end of the year is my guess. And we'll see. It might take a little bit longer to get there. I don't think it's going to go down as quickly as it went up, obviously. But my prediction has not changed that we continue to see rates steadily improve as the year goes on. And I think we definitely see a recession as we move towards the third quarter. It's just how deep of a recession is it? And when is the stock market going to recognize that we might be headed towards a recession? Because they seem to be quite resilient. So you guys, that's kind of my take on where we're at here at halftime in 2023. I got to tell you, I sure enjoy coming on here and giving market updates, the great interviews that we do here on Market Shares. I hope you're enjoying the content. Leave in the comments below if there's anything in particular you'd like to have us focus on, talk about in a future episode. If there's things you like, things you don't like, hey, it's halftime for us as well. So give us your feedback on what you like about Market Shares and what we can improve on. And also, if you haven't already, please like and subscribe to the channel. And more importantly, share it with someone in the mortgage industry. Mention it to them. Tell them about it. I love to see more people in this industry tuning in and checking out the latest episode of Market Shares. So with that, you guys, thanks for your time and attention. And until next time, bye for now.